Hi everyone and welcome back. If you're planning for retirement, you're probably focused on one big question. How much can I actually withdraw each year without running out of money? Now, traditional wisdom says that we should be conservative in retirement and dial down the risk. But what if I told you that more recent studies suggest being slightly less conservative, at least in the early years, and that could actually increase your sustainable withdrawals? And so in this video, I'm going to dig into the research and cover retirement glide paths and consider whether a counterintuitive approach could be the key to unlocking a more comfortable retirement. For those of you familiar with investing, you've likely heard of glide paths anyway, in the context of target date funds. Simply put, a retirement glide path is a strategy for adjusting your investment assets allocation over time throughout your retirement. It's usually about managing risk and return as your life stages change. Think of it as a planned evolution of your portfolio mix of stock and bonds as you move through retirement. Now, the traditional approach is a declining equity glide path. The idea is pretty straightforward. In your younger years, you can afford to take more risk and therefore higher equity allocations to maximize your growth. But as you approach and enter retirement, the conventional wisdom says you should reduce your stock holdings and increase safer assets like bonds to preserve capital. And this is meant to protect you, especially from market downturns early in retirement, basically the sequence of return risk that everyone talks about. Let's quickly break down the pros and cons of this traditional declining path. If we think about the good side, the pros, it feels intuitively safe. Lowering equity exposure as you age seems quite prudent. It's designed to reduce portfolio volatility and the risk of big losses, especially later in life when you have less time to recover. So that can be psychologically comforting. However, the cons, the downsides, a major downside is the opportunity cost. If equity markets perform well later in your retirement, you'll miss out on potential gains by being heavily weighted in bonds. Also, with increased longevity, retirees are living longer. So by being too conservative too early, it might mean your portfolio struggles to keep pace with inflation and that longevity risk. So here's where things get a little interesting. Some research is challenging these traditional approaches and suggesting that a rising equity glide path may actually be better. They're saying that increasing your equity exposure as you get further into retirement might be a better option. Now, this sounds counterintuitive, but the logic is sound. The core idea in the research, and this is from Michael Kitchers, it talks about by starting with a lower equity allocation in early retirement, you're less vulnerable to those devastating early market downturns. And if the market performs poorly early on, you're protected. If it performs well, you can gradually increase your equity exposure to capture more of the upside later in life, when, ironically, you might be less sensitive to short-term volatility because your portfolio has weathered the critical early years. Let's go through an example. Kitchers compares a declining glide path starting at 70% equities and decreasing to 20% over 30 years, with a rising glide path starting at 30% equities, increasing to 80% over 30 years. He also looked at fixed 50-50 equity bond allocation as a benchmark. Notice the quite stark difference. With a declining path, you're aggressively de-risking. With the rising path, you're strategically increasing risk over time. The research found that the rising equity glide path actually leads to a higher probability of success, meaning a lower risk of running out of money and potentially even higher sustainable withdrawal rates. So in essence, by taking slightly less risk up front, you might be able to withdraw more over the long term. So if we think about it, if you can safely withdraw, say, 4% with a traditional approach, could a rising equity glide path potentially allow you to withdraw even more sustainably? And of course, while there's no magic number, the research does suggest or point to this possibility. By better managing that sequence of return risk and participating in potentially longer-term equity growth, that rising glide path aims to optimize your withdrawals. Also, we're living longer, maintaining some equity growth potentially throughout retirement can be even more critical to combat that longevity risk. And of course, before we rush off and overhaul our retirement portfolios, there's a few important caveats. Firstly, rising equity glide paths are more complex to manage and may require active adjustments over time. Secondly, this approach is still debated. Not all research definitively concludes that rising glide paths are always superior. Market conditions, your individual risk tolerance, and your specific situations all play a role in identifying the best approach for you. And finally, no glide path, rising, declining, or staying static guarantees success. Retirement planning is inherently uncertain. So what's the takeaway? Well, the traditional declining equity glide path is a sensible and time-tested approach. However, emerging evidence on rising equity glide paths is quite compelling, and it does deserve serious consideration. It challenges that conventional wisdom and suggests a slightly different path might unlock greater security and potentially higher withdrawals in retirement. So you need to really do your homework, take a look at these studies, and they're linked below in the description, and understand your own risk tolerance. The right glide path for you will depend on your unique circumstances, and for many, a regular rebalanced 50-50, 60-40, or even 70-30 portfolio may not be the most optimal route, but it is simple, and often keeping strategy as simple as possible allows you to better implement it, keep on top of it, and make sure that you're managing it in the right way. So are you using or are looking to use a glide path in retirement? Be interested to hear what you're doing in the comments. And if you found this video useful or interesting, please like, subscribe, and pass on to someone else who you think might gain some value from it. Thanks for watching.